Today, what I want to do is walk you through a fund. Now, I used to work at Vanguard. I know a lot about investing, and I want to show you what goes through my mind when I'm looking at an ETF that I'm thinking about investing in. And we're actually going to be looking at an ETF I am currently invested in. These days, I only invest in 2 ETFs, one of which is VXUS, the Vanguard Total International Stock ETF. My goal here is by the end of this, you have a bit of a rubric when you're looking at a fund that you can follow to understand what's going on. You're going to see what I care about and what I don't care about and why. And let's just go ahead and start by looking at the ticker here. Tickers are nice to know because if you need to find the fund or when you go to purchase it, you're going to need it. It's useful. It's just a little nickname for the fund, VXUS. It stands for the Vanguard Total International Stock ETF. Let's go ahead and break down the fund name here, because once you learn how to break down fund names, you can quickly realize what's going on. Vanguard is the provider. So Vanguard is a giant fund manager. They have tons of ETFs, and they're a very reliable brand. A reliable brand does not guarantee that you're going to get a good ETF or a good mutual fund, but it certainly increases the odds. And there are other things we're going to check to make sure you're doing well. But brands like Vanguard, Fidelity, iShares, which is actually BlackRock, they just call themselves iShares for their ETF lineup. We have Charles Schwab, Spider, which is State Street for their ETF lineup. Those are, in my opinion, some very reliable brands. And brands that don't have this stellar reputation can also have great funds as well. It just increases the likelihood of getting a good fund if you get it from a brand you know and trust that has a good reputation. Vanguard is one of those. And again, full disclaimer, little bias about Vanguard. I used to work there. Next, we have the total international stock. So we're looking at all the international stock excluding the United States. That's just that is just strictly assumed. When you see a total stock market fund, you should assume it's US stock, and total international stock funds assume everything or invest in everything but domestic US stock. And then ETF, this just tells us it's an ETF. It's traded by the share. It trades like a stock, as opposed to just a mutual fund, which is often listed as fund at the end, which trades once a day at the end of each day. You can be successful investing in a mutual fund or an ETF. They both can provide a low-cost, well-diversified portfolio to meet your investing needs. So don't stress on that point too much. Now let's go ahead and get into the key details. 1, index funds. Index funds will outperform active funds on average over the long term because index funds' costs are so low. And so seeing management style index is really good. Index funds are far better for the average investor than any other investing strategy, 99.99999 repeating % of the time. If your name's not Warren Buffett, you should look at index funds. Additionally, Warren Buffett also says the average investor should be looking at index funds. You're welcome. Now we're going to go ahead and look at the asset class here. We're seeing international global stock. Great. And so we know it's going to be an international fund, living up to the name. You do want to check, and we will be looking at the portfolio in a bit just to confirm these are international companies. We see foreign large blend. Not much of a surprise. The words large blend might catch you off guard, though. We know foreign, it's international. Large is there not because it doesn't have small companies in it. Total stock markets buy up everything. But in the global economy, the large companies make up most of the stock market. It's true for the US market. It's true for all the other markets. Large companies dominate. So when you see a total stock market getting sorted into a category of large, mid, or small, they end up being listed under large, even though they have lots of mid-sized and small-sized companies in them. Blend refers to having a mix of value and growth stocks. These are stock styles. We're not going to go into it. But when you see blend, you have all kinds of stuff. You're not trying to just value companies with a high chance of growth or companies that have a good book value to price or earnings to price ratio. None of that jazz. We're looking strictly at a big mix here. Expense ratio. This is important. You always want to check this on every fund. If you don't know what you're paying for the fund, you don't know if you're really going to benefit from it as a good investment, or if you're just getting ripped off. Don't get ripped off. Market price is tempting to look at. You can ignore it though. In the world of investing, this is actually very easy to rig. I can announce that I'm doubling everybody's shares and halving the price. So you have the same amount of ownership in the fund, but it's a cheaper market price. Likewise, I could have your shares and double the price, same amount of ownership in the fund, but the price is now doubled. That doesn't matter. The actual fee and cost you're really going to be paying is the expense ratio. This is a 0.07% expense ratio, which translates to $7 for every $10,000 you have invested in the fund per year. This is your yearly fee, so to speak. General rule of thumb, the thing you want to do is make sure it's under 0.2%. That is where I personally draw the line. That's also known as 20 basis points. A basis point is 0.01%. Keep it under 20 basis points. Seeing that it's 0.07%, great. It's a cheap fund. That's what you want. One of the best indicators you can control when it comes to fund performance is what you're paying for the fund. You can't control whether the companies this fund invests in does well or not, but you can control how much of your gains are going to the fund managers and how much are going to your pockets. The less you're paying for people to manage the fund, the more of the return you get to keep. Now, if we go ahead and scroll down here, you will see a product summary. This is very, very important to read. Every firm has some kind of summary explaining what the fund is. Go through it. Sometimes it'll be a paragraph. In this case, we see bullet points. It's really important to understand what's going on here. We see that this is an ETF and it's tracking this index. Seeing that it says it's seeking to track the performance of the FTSE Global All Cap Ex-US, you quickly realize, yes, this is an index fund. It's living up to its name. It's tracking the index, not trying to beat the index. And we notice that the index it's following is all cap, all different size companies. FTSE is the index provider. Global means it's the entire world, but it's excluding the US. So it's doing what we think it is doing. And likewise, it summarizes that down below right here. It measures the investment returns of all stocks issued by companies located outside the United States. So it's tracking the investment return of all stocks issued outside the USA. Great. It's living up to everything I expected it to do. Fantastic. And what's it good for? Well, it broadly exposes people across developed and emerging non-US equity markets. Equity is another word for stock. Great. You're buying up everything. And we see they really hammer the index point home. Follows a passively managed index replication approach. Great. And we see that the fund management group is in fact Vanguard. Sometimes firms, especially if they have active funds, will have 3 or 4 groups managing the fund, because if one group has a good idea and another group has a bad idea, they might be able to average it out okay. If you have just one group managing a fund and they really botch it, that fund's going to go to zero. But we're worried about indexing. We're copying what the market is doing. We don't need a lot of fund managers here. Great. Let's go ahead and scroll down a little bit more. And we've come now to performance. Now, this is the exciting bit, because I know the average investor comes here and they say, you know what, I bet the last 10 years is going to happen again. And so this fund will definitely, certainly 100% return 4.3%. That's going to be great. Except that's dumb. That's like saying the past lottery numbers will come up again. That doesn't really happen, does it? Who knows what's ahead? We just had COVID-19. Wow, when's the last time we had a global pandemic shut down the entire world? How about the last time? 2008. It was the worst economic crisis we've had in the United States and around the world, I would say. Given that's an international fund, but it does apply. 2008 really affected everybody. 2008 was the worst economic crisis since 1934. Maybe 1933, Great Depression. It doesn't seem like these events come up that often, do they? So looking at the last 10 years and be like, it's going to definitely happen again. No, it's probably not. Probably not. The performance, generally speaking, should be ignored. You should be shopping for a piece of a puzzle, trying to build out a portfolio. This isn't actually that useful. People will try to sort funds by 10-year performance and be like, I know what the best one is, but that's not what you need to be thinking about. You need to be trying to get a low-cost, well-diversified portfolio that meets your needs. So this fund is a great way to get international stock market exposure in a very well-diversified way at a low cost. If that meets your needs, this is worth considering. But the performance doesn't really affect it. Doesn't really affect whether the fund is worth buying or not. The next 10 years could be great internationally, and the United States could have a giant economic disaster. So this 4.23% could spike up to 14%. The rest of the world could be doing great while the United States suffers. Who knows? I can't predict the future, but you can prepare for it with, again, a well-diversified, low-cost portfolio. So what do I care about here? Well, one thing I personally care about is number of stocks, right? This is supposed to get me the entire world except for the United States, so I expect a lot of companies here. And VXUS delivers with nearly 8,000 different investments in here. Now, we're just buying up the world, so all the other stats here don't really matter all that much. You can do a little bit of a shortcut here and look at fund total net assets, which tells you how much money is invested in the fund. And for Vanguard funds, they're a little weird. They have a bunch of different types of funds for any particular fund. So they've linked their mutual fund and ETF. So you have all these different versions of it. So for the Vanguard Total International Stock Funds, in aggregate, there's 358.7 billion, of which 53.1 billion is in the ETF form. Cool. It's a little complicated. But what you can do is say, hey, if a fund has a lot of money in it, investors trust it. Given that this has $358 billion in it, that has to feel pretty good. People are trusting, individual people, institutions are trusting Vanguard and the managers of this fund with $53.8.7 billion. That's a fair chunk of change, a little shortcut there. But I do see what I like to see. And again, I've invested in this fund. So, I'm not making this up as I go. I've did my research before I invested myself. And it may or may not be appropriate for you. What's good for me may not be good for you. But we see nearly 8,000 companies. I'm feeling good about that. Now, what we want to do is scroll down. We see, if we look here, a bunch of international exposure by region, right? We have a lot of emerging markets, a lot of Europe, Pacific, not a ton of North America. The United States makes up about 50% of the global stock market, but because we're excluding that, we're getting stuck with things like Mexico and Canada, which are a much smaller part of the whole global stock market. So just a little bit of North America here, a lot of what most people would think of international here. Emerging markets, Europe, Pacific. Cool. Last thing I'd want to do when looking at a fund is take a look at its actual investments, just to really make sure I'm getting what I think I am. If I see Apple here, something is wrong because that's a US company. If I see Facebook here, I would be a little concerned. But these days they call it Meta. But I do see a bunch of companies that aren't associated with the United States. We've got Taiwan Semiconductor Manufacturing, Nestle, Samsung, Shell. We got Louis Vuitton. We got a bunch of companies that are outside the USA. I'm feeling really good. I'm not going to be going through 7,876 of them. That's a lot of them. And at showing 10 a page, we have nearly 800 pages to go through. I'm not doing that. But I do see plenty of companies I would want in my portfolio. Great. So this fund seems grand. You should always feel free to go to fund literature and read some of the other information here if you want to learn more, especially something like a summary prospectus that kind of summarizes a bit more about the fund. But all in all, that's what I look for. Notice I'm not really focused on performance when I'm going through it. When I chose to invest in this fund, what I said is I want a very simple portfolio. I need international exposure. So where can I get really low cost, reliable international exposure? And I settled on this one. A brand I trust. Again, I used to work there. Low expense ratio, very well diversified, reputable company. And it fills the thing I was looking for, international exposure, because I already have a domestic ETF, which is the Vanguard Total Stock Market ETF. Think of it as it's like these are brother and sister. One is US, one is international, and then I just rebalance between the two. That's my whole portfolio. Hopefully you learned something while going through this analysis of a fund. You know where I'm looking at. You know why I'm not looking at something. Ultimately, the key thing is to also know what you're shopping for. In this case, I knew I wanted international stock and I found something I liked. If you don't know what that is, tune in for more videos or come by the stream to learn how to actually shop around and figure out what you need in your portfolio, because that's how it's supposed to go. You go from figuring out what you want in your portfolio and then you shop for that. You should not under any circumstances be reactionary. Looking at funds and just adding them willy-nilly because you like them. You need to be shopping. You don't go to a grocery store and not know what you want to buy. You come up with a list and then you start shopping for the best good available. Anyways, subscribe if you like that. See you in the next video.